Hello and welcome to your Monday Technical Market Outlook for July 13th, 2009. This is Patrick Sresna. First off, I want to take a look at the weekly chart of the S&P 500 going back several decades, and when we plot an 80-week moving average on that, it has done a very good job to depict the bull and bear market cycles that the market has gone through. When we crossed over in January 2008 on the downside, that's when we began our thesis that we're in a bear market that should last many months, if not more than a year in total duration. And now we're of the opinion that this will obviously last at minimum to the fall of 2009, but can extend into the 2010 year. Now I want to take a closer look at the S&P 500 using the SPDR exchange traded fund symbol SPY, and more or less at this stage we've got a completion of the pattern that we've been looking for the last couple of weeks, which was a final test down into that 86-88 zone. So now that we've gotten the testing and support holding in this area, the question becomes, what do we expect now? If we were to listen to the broader media and all the junior technicians out there, the most common thing that everyone's looking for is this head and shoulders top. And they more or less are anticipating a breakdown of the head and shoulders top to see an accelerated move down to the 82, 81, 80 level on the downside. And that's sort of what everyone's anticipating. The one thing that I've known, at least from the years that I've watched the market, is that when something is so well advertised and so well watched, very few times does it actually play out like everyone expects. And therefore, the fact that this is so actively being promoted, it certainly diminishes the likelihood of it actually occurring. So if that scenario is actually not the likely outcome, then the reality is that we may be looking at it returning back to the top end of the trade range bound market. And that's the scenario that we're putting more strength behind at this stage. The one thing I do want to stress, even though we do believe that this is the likely scenario, if we were to break below the 86 level, it really throws this model right out. So we actually are a very important key focal area where at this point, if we're going to stay range bound, it's going to happen from here. And if we're going to break down, it's also going to break all we need is a little push off the side of this cliff, and then it'll accelerate on the downside. So at this stage, I'm favoring this trade range bound market. But as soon as we have any technical breaks with any, especially if it comes on volume and with accelerated selling down below 86, at that stage we have to look at the pattern actually playing out down into that 79.81 focal point on the downside. Just to review our key points, our thesis since January 2008 has been that we're in a bear market that should last many months, if not more than a year in total duration. We added to that many months ago by suggesting that this could end as early as the fall of 2009, but can realistically extend into the 2010 or 2011 years. We continue to position ourselves for a range-bound summer, but we are actually at the critical moment for this scenario. Any technical breakdowns beyond here, we have to visit the idea that the sell-off actually occurs during the summer and we rally into the fall. We are anticipating numerous false starts for both the bulls and the bears during this range-bound market, and long-term investors still need to be cautious, avoid overexposure to the markets, and only short-term actively managed trades are prudent. Next here, I want to take a look at the NASDAQ 100 using the exchange traded fund symbol QQQQ. And here we had the selling come right into the bottom end of that 34.5 to 35.5 zone. Again, the NASDAQ is holding up much better than the broader markets. And so the selling is contained here. Again, if we are going to have that range-bound mark in the S&P, then these bottoms will hold, and we'll probably see it come back to the top end of that range in the next push. Next here, I want to take a look at that US dollar index, and one of the things that we were watching carefully was that triangle style formation that's wedging this market price action here, and we were really anticipating this to break down. But the thing is that, again, we're now going into almost 4 weeks of continuous range-bound price action for that US dollar. The scenario we were always looking for was the technical breakdown on the downside, which would end up being very bullish for commodities. But the reality is that the longer that the support lines hold in around this 79.80 zone on the downside, the more likely scenario starts to develop is that the US dollar index will break higher up into the 82 to 83 zone. Now, which one of these scenarios plays out? We're waiting for the US dollar index to make its move to give us the indication, but commodities are already selling on anticipation of that US dollar strengthening. So we'll see whether that pop does occur. But if the US dollar index makes a technical break below 79 on the downside, there should probably be a significant rebound in commodities in a broader sense. Next here, I want to take a look at gold bullion using that Spider Gold Trust exchange traded fund symbol GLD. And more or less, we were watching that 90 support line, which is marked by the blue, and we spent several days actually trading below or at it. This is actually extremely critical, because if gold is going to make a bottom, it has to hold these levels. As a matter of fact, it's a slight overshoot on the downside, but nonetheless, it could still rebound back on the upside. Any technical breakdowns still lower from here really opens that window for a bottoming around the 85-87 zone, or maybe even making a bigger picture drop from there. So we're about to get the critical information right now. Next here, I want to take a look at crude oil using the exchange traded fund symbol USO. And when crude broke below that 36 level on the exchange traded fund where we were watching last week, it really did open that window for that very aggressive selling, which hit down into the 32 level very quickly. Now, the selling was very intense, which at first glance appears very bearish, but we still have not done the technical damage, which is actually below the 32 level. So long as this level holds and we start seeing reversal patterns coming up in the next 2-3 weeks, then more than likely we still have the window open for what may be another push back up to highs or higher. But any technical breakdowns that start dropping below the 32 level, it no longer becomes a consolidation, but rather begins to look far more like a reversal. And so really this is a critical level on that crude. We're going to be watching that carefully, and especially whether or not we get reversals off this level. Next here, I want to take a look at a broader basket of commodities using the PowerShares Commodity ETF, symbol DBC. And here we've seen some significant technical damage as we've broken that critical 21 level on the downside. The weakness in a broader basket of commodities has been much stronger than what we've seen in crude and gold. And that may be a tell in terms of how everything's going to play out here. But nonetheless, we're very carefully watching whether or not we get a quick snapback reversal here, because if we don't get an immediate snapback early this week, then really it does open the window for this to trade all the way back down to its previous lows. For those of you that like to learn more about how we trade stocks, options, futures, and forex markets, please visit us at thepowerofoptions.com and register for our free educational event on Monday, July 20th from 7 to 9 p.m. And that was your Monday Market Outlook. Thank you for joining me.